With the market seemingly turning around, I anticipate TGEs or token generative events to start hitting the crypto landscape once again. Usually in the market uptrend, many people try to capture that attention, that positive price action, and launch their own token. And this video, I think it's time we actually help you understand how to look into tokenomics and break them down to make sense of where the price action's going, why it opened up at what price it did, is there overhang, is there risk, what's the best buying opportunity, all the tangibles. And I mean, let's just break it down real quick. Have you ever bought a token just because it was on trending? And I'm not talking meme coins. A new L1, a new L2, a new DApp, actual product that's building, only for it to nuke 48 hours later? Yeah, you're not alone. But here's the thing. That's because most people don't know how to read tokenomics. And in this video, I'm going to break down exactly how to read crypto tokens before you buy it. We're going to cover supply, fully diluted value, unlocks, inflation risk, and I'll even show you how to apply it in real time using actual trending tokens. First things first to dive into: circulating supply versus max supply. The circulating supply is how many tokens are live in the market right now. And the max supply is how many tokens can exist. So as we look at something like Bitcoin, those tokens are emitted through mining. And as time progresses, more coins hit the market, giving it a more closer representation of what the actual market cap will be. Now, if we want to find the red flag, if only 5% of the supply is circulating, expect major inflation as the rest unlocks. For example, we just saw a recent gaming token. I'm a fan of the game itself, but it's what many people have speculated is a low circulating, high FTV. And with that, it has a certain number of tokens that are out. Let's look at a 1 billion token supply right now. It has a total of 1 billion tokens, but on token generative event, only 500 million are live. So only about 50%, which means that over time, another 50% of that supply will hit the market. We've even seen more extreme cases of this. Tokens with 100 billion total supply, but only 3 billion circulating. That's only 3% on the market. So of course, the price action is going to be positive. There's barely any tokens out. And because of that, this is where you got to look at circulating supply, which is that initial market cap versus fully diluted value. And that's the next part of this that I want to start to cover and talk about. FDV, or fully diluted value, is how much the token is worth if all of the supply was on the market. Market cap is just the circulating supply's value. With pump fund tokens, obviously 100% of the supply is on the market, so that market cap is equal to the fully diluted value. But in those examples above, even Bitcoin, for example, its market cap is not one-to-one to its fully diluted value. With new tokens, if you have $100 billion coin and there's 100 billion tokens, you would expect that to be $1 trading, right? But if there's only 3 billion tokens on the market and the value is 100 billion, the value of the token for its market cap will be significantly higher to make up for that. Of course, this is where you need to start to break this down. If a token launches and it's trading at a 50 billion FDV, but its current market cap is only 100 mil, that's a big concern because the market cap is significantly lower, despite its FDV being significantly higher. So in order for that market cap to sustain as more tokens roll out, that price is going to fluctuate a ton. And this is where you need to start to be more logical about it. You could think you're early, but if the FDV is already 50 billion and there's no utility, that's a bubble waiting to pop. So I mean, if we look at something right here, the market cap is 100 mil, but the FDV is 1.2 billion. That's a 10x difference. A huge dilution risk is present. You want the market cap to be closer to the FDV. If there's a very low number of tokens on the market, that has overhang risk. That has a ton of upcoming unlocks, release, emissions, more things for more tokens to flood the market, ultimately pushing the price of that current token down. If you're buying in early because you think it's going to go up, maybe it will, but when those unlocks hit, the likelihood of that price action sustaining is extremely low. Now continuing to look at this, and the next thing here, we've teased on it a little bit right now. Unlock schedules and emissions. You need to know when tokens are unlocking. When big venture capitalist unlocks are happening, usually that means sell pressure. We just saw the biggest unlock happen for Solana. And Solana went from $290 all the way down to sub $100. The tool that you can very quickly look at is called the Tokenomist, Tokenomist.ai. It does a great job for analyzing upcoming unlocks, linear releases, cliffed unlocks, and all the data points, dynamics, information that you need to understand what's happening. For example, there's some cliff unlocks happening over the next few days for things like Aptos, Strike, AXS. And even today, there's been some linear unlocks that we can see, whether it's on Solana, Wild, Celestia, and more. And what those linear unlocks look like. Even right now, there's about 7.9 million Solana tokens unlocking every single day. That could be a concern for many who are hoping for upward price action down the line and for Solana to regain its all-time high. You can use other tools. Of course, I mentioned the Tokenomics.ai. It's AI powered. It gives us good insight, helps us really quickly analyze majors, alternative currencies, a bunch of other key things to help us very quickly figure out what that unlock schedule is. And if a big unlock's happening, is it daily unlocks like linear? Is it a cliff unlock, which is a blank period where no one's gotten tokens and they get a bunch at once? And those are things you need to be conscious of, because those cliff unlocks, even linear unlocks, especially when linear unlocks increase, usually mean more sell pressure because people need to recoup the initial cost that they spent during those venture capitalist raises. So it's a lot of things to consider, a lot of information that you need to be on top of, but it's going to help you make more informed decisions when picking up majors, picking up altcoins, analyzing where the market's going. Is it a good time to take profit? Is it a good time to average in, especially right after unlocks? Despite them being sell pressure heavy and somewhat bearish, usually that means it's a good time to buy in before the next unlock, as people can want to see price action increase to get the most out of their unlock after this most recent one. So it tends to be a decent buying opportunity if that sell pressure hits the market. If a token is a major unlock coming, don't FOMO in. That's a key thing. We talked about it in the previous video about not FOMOing, having a solid understanding for that, and timing your entries based on unlock schedules can be extremely beneficial, especially for long-term trading, long-term recognition of dip buying, DCAing, and more. One of the other key things I want to dive into here is inflation and emission models. Some tokens print endlessly and others are deflationary. So when we look at something like ETH, when gas prices are high, it is deflationary. That's a bullish catalyst. When gas prices are low, it's no longer deflationary. More tokens are emitting. That's a concern. Things like Solana, a recent proposal went out in which the emission schedule would have been changed. That sadly did not pass. Solana is still emission heavy. And the way that people offset that are by staking to Solana validators. But of course, when emissions are heavy, more tokens are hitting the market. It plays back into something we covered earlier in this video. Understanding unlocks, emissions, more tokens on the market, fully diluted value versus market cap, all of those things need to be considered. Are tokens being emitted to farms? Are rewards sustainable? We saw with Axie Infinity, tons of people playing the game, emission schedule got too heavy, too many tokens flooded the market, price ultimately crashed. However, if you're early to these, you can usually print on these farms. So finding decent farms and decent emission schedules on an earlier newly released token could actually be rewarding and fruitful for you because you're gaining a large portion of that market share and capturing those emissions. So you can also check though, is there burn mechanisms? Things like Jupiter buybacks is a burn mechanism. There's other tokens as well that do a variety of different buyback and burns that we've seen massive success from. We got to also look at where the demand is for these tokens. Is there sinks? And what that means is use cases for the token. Because if there is, then emissions aren't terribly bearish. If anything, the sinks could outweigh the emissions, making price action move up as more deflationary mechanics are happening and more of the tokens are burned. That's a very positive sign. Now, of course, I want to just give you all this information to help you start to do more due diligence as more TGEs are happening, whether it's a gaming token, a DApp, a new L1 or L2. There's a ton on the horizon with Monad, Mega ETH. We obviously just saw Kaido. We have things like Wayfinder that just released and so many other things that you should be doing due diligence on to figure out when the opportune time is for you to make an entry into that coin. Now, where do you want to research these tokenomics? There's a few different places you can look. CoinGecko and CoinMarketCap, great places to check high-level information. Fully diluted values, circulating supply, current market cap, very quickly. DeFi Llama, and what we also said was Tokenomics.ai, both quality platforms to check on things like unlock schedules, TVLs versus FDV insights, flows to chains, inflows, outflows, where it's coming from, just token movements, and when those unlocks are happening, when more supply hits the market. Using these tools and these products will help you become a pro and figure out exactly what the best case is for you on these investment decisions. Now, of course, if you want to stop being exit liquidity and start reading tokenomics, these are some simple checks that you can make. Many projects also release documents, white papers, and more, where you can read on what those allocations are. How much are insiders, VCs, the company, community getting? How much is going into LPs? How much is being rewarded to the community? What's the emission schedule like? All that information for almost every token is either in a white paper or in a document that the team does publish. If the team doesn't publish public tokenomics, I'd probably stay away. If they don't, you're going to be exit liquidity. But let me know what the last token was that you bought without reading the supply. What was the last thing that you dove into and didn't look at the tokenomics? I won't judge you. And as always, hit the sub, hit the like, leave a comment, keep it easy, and we'll catch you next time.